I think when we previously talked about the markets generally, you mentioned obviously the largest pools of institutional capital outside of Japan would be Korea, China, and Australia. I just wanted to get a sort of understanding of what you're seeing from your clients in those markets. How are they thinking about positioning for China, for example, which is the elephant in the room, if you like?
Right. I mean, I think that there's a bit. First of all, I think the institutions in Asia are quite knowledgeable on China. They're in the region. They've spent already a lot of time. Some of them are already quite well allocated. And I think there's a little bit of a wait and see approach right now in that, I think the market is looking at when the currency will become fully convertible, in which case the market will open up dramatically. I mean, we've already seen year to date a tremendous, run up in the equity markets as we're seeing, an opening up or an assumption of the further opening up of the capital markets in China. So I think they're watching that, and they continue to make movements to continue to increase their allocations. I saw in the press recently, I don't know whether it was AsianInvestor or not, that GIC recently got a QFII allocation of their own. So certainly they're all looking to start building up larger positions, because when China does liberalize its capital markets, it's obviously going to be a much larger share of the global capital markets.
Yes, absolutely. I suppose, emerging markets more generally, China obviously is at the forefront of that, but emerging markets more generally, again, I know difficult to generalize, but, in the opportunity that you're talking to your clients about in emerging markets, what does that revolve around? Because there's a valuation perspective here, what happens with the US dollar and raising interest rates in the US. So there's a lot of factors to take into account.
So it's interesting, you asked about China first and then we moved to emerging markets. That is a recognition of China being so important in the context of emerging markets. And I might say that for our own business, we've certainly recognized that, and we've recently merged our Asia equity business with our emerging market equity business under the leadership of Richard Titherington to really recognize that Asia is going to be such an important part of getting the emerging market story right and being able to really have resources to support the analysis on China. In terms of the views on emerging markets right now, there's no doubt that there are some headwinds. Valuations are attractive from a historical perspective. On the other hand, we've been somewhat disappointed by earnings growth. The dollar is a headwind. These countries still have a certain amount of dollar-denominated debt. They've diversified their debt, but they still have meaningful dollar-denominated debt. That's a headwind for these economies. So I think that, again, many of the institutional investors in Asia are relatively overweight. One would, you could say from a sort of a GDP-weighted basis or a capital market basis in Asia because it's their backyard, and in emerging markets because they're very focused on growth. So I think that with valuations where they are, I think there's definitely a maintain at this point. Some are looking at it as a place to start increasing perhaps their allocation if they are fully convicted on the emerging market story. But it's mixed right now because there isn't a very clear view in terms of what gets the emerging markets to sort of lift off again.
Mm-hmm. Is there any commonality in the types of questioning the questions that you're fielding from institutional clients on emerging markets?
I think they continue to come back to what will change the tide on earnings growth. They're looking for earnings growth. I mean, it's a growth market. You need earnings growth here. So there's a lot of the questions revolve around what are the triggers? What should we look for? When will we see the change in earnings growth? But it's very hard to generalize again about emerging markets. One of the things that we certainly point out to clients is that not all of these markets are the same. For example, we've had this big move in oil. Not all the emerging markets are affected in the same way by oil. Some are, consumers of oil. Some are exporters of oil. That has a different effect on, each of those countries. And then beyond that, obviously, into the industry level, there'll be winners and losers in terms of industry. So in general, I would say institutional investors, given the outlook that they have around compressed beta returns, are really looking at being more active in their approach right now.